Hey, what's going on, everyone? My name is Adam Campbell, and today I will be doing my investment analysis on Coca-Cola with the ticker sign KO. So let's jump right into it. So everyone knows who Coca-Cola is, big beverage company. You see them in every restaurant, every vending machine, and they own a lot of brands that you may not know. So a little refresher here is Coca-Cola is a non-alcoholic beverage company founded in Atlanta, Georgia in 1886. They're a global brand that reaches over 200 different countries. Coca-Cola also owns and distributes hundreds of brands, with few major ones being Coca-Cola, Sprite, and Fanta. There's even ones like Powerade and Gold Peak. You might not know that those are owned by Coke, but they are. And their fiscal year 2024 financial report showed that they had a revenue of $47 billion, an EBITDA margin of 38.1%, a net income of $10.7 billion, a market cap of $277.4 billion, and an EV to EBITDA of 21.4. So let's look into the investment thesis. We'll be looking at the global brand and distribution, the fact that they have a high margin and are very asset light, their pricing power, their free cash flow, as well as the fact that the DCF shows that Coke is undervalued. So looking at the global brand and distribution, Coca-Cola products are simply everywhere, from vending machines to restaurants. It makes it super hard to compete when one of the biggest companies is worldwide. Um, for high margin and asset light, they don't own all factories or bottlers. They simply use licensing brands, which keeps costs low and margins high. For their pricing power, Coca-Cola can raise prices without losing customers thanks to their strong brand loyalty. It's always between, you hear it, Coke and Pepsi. And both of those have a lot of brands that have a lot of loyal members and buyers. So both of those companies can kind of do whatever they need to adjust their prices to fit their needs without really having any issues. Free cash flow, it generates reliable excess cash, allowing reinvestment and dividends. And a discounted cash flow, like I said, shows that Coca-Cola's true value is much higher than its market price. So real quick, we are going to switch over to my Excel file. I want you to take a look at the things highlighted in green. This is the recent financial trends. You'll see that we have revenue, net income to company, basic EPS, as well as EBIT. So the revenue here just shows that they have been steady post-COVID recovery and demand growth. So they've continued to do well even during some of the hard times. The EBIT shows a strong growth driven by margin expansion. Their continual rise in their EPS obviously attracts investors, and then their net income shows a healthy bottom line growth. So let's go on back to my slides here. And we're going to look into the valuation approach. So the forecast period that we looked at was from 2025 to 2034. The revenue compound annual growth at 3.34%, that's slow but steady growth. It's fitting for a mature company, definitely for a big company. It's not flashy, but it's going to be reliable. Your EBIT margin at 33.9%. It's just a profitability assumption. It's consistent with recent trends for sure. At 33.9% is very good and shows that they are very efficient. The WACC, which is the weighted average cost of capital, represents Coca-Cola's cost to raise capital. 5.8% reflects a low financial risk and makes future cash flows more valuable in a DCF model. The terminal EV to EBITDA assumed exit multiple is used to calculate the business's value at the end of forecast, 21.4 times. This is shown because of their low risk and high premium. And then their value share, like I said, the DCF shows a derived price far above the current stock price, which is $73.3. And with the value per share being at 109, that would consist of a strong buy. Continuing to move on, we'll look at some of the key financial drivers. So the CapEx at 7.1% of revenue shows that Coca-Cola can sustain operations with low reinvestment. The operating margin at 28.8% it's definitely a high margin, but it's efficient and profitable business and is a sign of a wide moat. And then the free cash flow going from 10.9 billion to 15.3 billion. That's grown free cash flow, which means they're more flexible to return value to shareholders, which is really awesome. And then we're going to take a look here at the balance sheet health. So, cash and short-term investments is $14.6 billion. This provides liquidity and buffer in tough times. Debt of $46.6 billion. It's definitely high, but due to their strong earnings, it's very manageable. Here's something that may raise a red flag when you're looking into the balance sheet is a negative net working capital. It is negative $11.1 billion, which obviously is a ton of money, but it shows negative because they pay suppliers slowly and get paid quickly, which is very common in consumer goods. And then the debt to EBITDA is 3.101x. It's a healthy level, not too leveraged. Debt is manageable for a big firm. And we're going to go on back to the Excel and let's see. So from slide 4, you can take a look here at how or where I found my numbers. Those are in the ones from slide 4 are in yellow, and then from slide 6 are in red. But I just wanted to take a quick look at some return metrics and efficiency. Some of the things highlighted here in blue. So we have the return on invested capital. It's 35%. So that shows how well the company turns capital into profit. So anything over 10% is really excellent. And then I also wanted to just highlight the EBIT here as because it reflects the strong pricing and brand power that Coca-Cola has. So we're going to go onto the back to the PowerPoint and finish up here. So the risk to watch. So their consumer preferences, sugar tax shifts to healthier alternatives. So a lot of people are starting to look into brands such as Poppy or just some of those healthier soda brands or even just healthier drink brands in general don't have as much sugar, not as much calories. So that's definitely a risk. The VX volatility shows that 60% of their revenue is international. It's not a huge issue, but could become an issue if things overseas start to get shaky. Their commodities, input costs, fluctuations like aluminum, sugar, and water. This is definitely an issue as we're starting to see some of the tariffs come into place. It definitely impact these and just put a tough time for Coca-Cola, make things end up being a lot harder. And then execution risk of bottler relationships, M&M integration. So let's draw a conclusion here. So they have a lot of brand power. Coke does. It's long-term moat. They're strong with stable cash flow. They have strong margins, like I said, efficient business, durable margins, and pricing power. They have a huge global footprint, diversified growth. Like I said, pristine global brand. And they're an undervalued stock, which is really awesome. Undervalued equity versus intrinsic DCF value. Definitely an opportunity for the investors. They have a very low beta of 0.6, so it's not a super risky investment. You're not going to get as much fluctuation. You're not going to make as much for your investment, but it's a whole lot safer than some of the other ones. And just wanted to say, like in the recent times since the tariffs have hit and the market's dropped, Coca-Cola has actually performed very well, stayed steady. So that's why it's a safe investment, definitely a good opportunity to buy now. But I thank you for your time. I'll be looking forward to any questions that you all may have. Feel free to email me, and I'll be looking forward to getting back to you. Thank you.